No.
Okay, now we are recording. Welcome, everyone. My name is Emily, Szerafy-Cox with the People's Justice Project.
Your
And
camera's you gotta
I know,
yeah, you
it's
can't
okay.
you can't I don't think that's okay though. 'Cause
Oh,
we see the back of your house, your room. There we go.
all right. Technical issue averted. Aramis, would you like to just introduce yourself?
Yes. I am Aramis. I am the executive director of the People Justice Project based in Columbus. Him.
Awesome. So, welcome to today's webinar called Better Than a Spreadsheet: Bookkeeping and Financial Reporting for Small Nonprofits. Aramis, did you say that PJP is a small nonprofit?
Yes, it needs to be. Stay that way too.
Yeah.
Yes.
Okay, so how are we starting out here? I'm curious, how comfortable are you, Aramis, with financial reporting or bookkeeping?
I'm not.
No? Okay.
But would you say again? Am I confident?
Comfortable.
I've never done it.
Okay.
Never done it.
What is something that you like about managing money?
Absolutely nothing.
Well,
I don't like it.
do you like spending the money?
I think it's like getting it.
Getting it. You like getting the money. Okay.
Well, was it? Well, let me be more clear. So, when you first start off raising money, you don't know what you need, and so you do the things and you get the money, and you, as for very lack of terms, you fake it till you make it, and then you will learn that there's more to the back office of a so-called nonprofit, because oftentimes you're just told you have to raise money, so you raise money, but you don't know where to put the money and then what to do when it's in your account. And so you need someone or people's who can guide that process. Because I remember, like, before you came around, I didn't know what I was doing. You know what I'm saying? I remember Erica was around, rest in power, and I think she kind of was like helping ish, but like I don't think she even knew what to do. And so I think like you're able, huh?
I said I'm not sure I know what to do.
Well, you know how to. You definitely have it. You definitely do.
We're figuring it out.
Yes. So I just want to end on this one saying that like it's when you don't know until you know, and so you need to learn how to bookkeep and do all the things, and yeah, it's a special skill.
Yeah. So, what is something you do not like about managing money?
Oh, because it's not real. It's just it's just you. I don't know, huh?
It's not people.
Yeah, it's like it's there, and then we do the things, and then you make sure the things happen.
Yeah. Well, I will say one thing that I like about managing money is that you can't like things will add up. At the end of the day, it's not like there's it's not subjective necessarily. I mean, I'm arguing with myself in my own head now, but like at the end of the day, there is kinda at least going to be an answer. there's an ending point, you know. Something I don't like about managing money is chasing people for receipts. Yeah, don't like that part. Tedious. So for those of you at home, we're going to use this later. Pull out a financial report that your organization has produced. And if your organization hasn't produced any financial report, then just go to wherever you track your money. Maybe that's a bank statement, but pull out some sort of way that your financial information for your organization is down on paper. We're going to use that later. So what is financial reporting? Literally, it is communication. It is a way to show people how money is being used in your organization. It's important to communicate that information to a lot of different kinds of people. One of the ways that it's helpful is that this information, it's shown for a particular period of time. And so it can actually help you with future planning to know what happened to your money during a certain period of time can help you plan for a future time. And if you think about the financial report as an expression of the mission of your nonprofit, then you're going to end up communicating better about the information that you're trying to convey through your financial reporting. We're going to talk a little bit more about that. So, why care? Ugh. Isn't this just taking me away from my mission, right, Aramis? You're like, I don't like it because it's not like the core of our struggle.
Yeah, the root of our struggle, indeed.
Right. But so if we think about what is power, right? Power is what we are trying to build. We realize power by organizing people. Of course, we know this. We organize people all the time. Organize information.
Yes.
And organize money. So organizing money can be about fundraising. And financial reporting can be organizing the info about the money. And that can be powerful because then you are telling a story of your mission by how you spent your money. So your mission feeds into your expenses, right? Like in order to realize our mission of the People's Justice Project, let me see if I can recite it, is to build power with Black and Brown communities impacted by state violence through community organizing and leadership development. I feel like I'm missing something in there. Anyway,
civic engagement.
Civic engagement. I don't actually think that's in our mission statement. Maybe we should add it. So that's our mission, and that tells you what we're going to do. And then our expenses better flow from that mission. So what are the main expenses that we have as an organization? The people, the food, the office, the printed materials, the outreach materials, that kind of stuff. So that's the story that you want to tell in your financial reporting. And when you do your bookkeeping, that's how you set yourself up to tell that story. Mm-hmm. So bookkeeping can seem really tedious, but it's like sorry, say it again.
No, there's a purpose to it.
Yes, exactly. Yeah. You're You're gathering all the pieces of the puzzle so that you can put the puzzle together and show it to somebody.
Yeah.
Okay, so now take that financial report that I asked you to go and grab and reflect to yourself for a moment. What story does your financial report tell? This is where we play a little bit of Jeopardy music. Do, 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 do.
Yeah.
No, that's not going to help you reflect. You can just put us on pause for a moment while you reflect. Yeah. Okay, moving on. So there are kind of 5 steps to making sure that your financial reporting is happening, period, and then is happening in a way that is going to best reflect your organization. The first is you got to assemble a tracking team. People. Hey, yes, it's about numbers, but we need those people to help us. Develop a tracking process. The people got to work together, go through a process, make sure everything's done. Create a tracking calendar, because tracking budget information, financial information happens on a regular calendar. And especially if you're talking to, like, if you're applying for grants, that sort of thing, they're going to want your financial reporting from one date to one, like they want it for specific periods of time. And then you got to work with that team to stay on top of it and check it, because the number of times that I've gone back to things that I've done in our bookkeeping and I look at it and I think, wait, why did I do it like that? No, I shouldn't have done it like that, right? So I got to check it before I close out. We'll talk about closeout. And then add it all up and communicate. So that's actually the reporting part at the end. Okay, so assembling your team. So who needs to be involved in the tracking process, in the tracking team? Well, anybody who spends money needs to be. Aramis, do you spend money for PJP?
Try
occasionally?
I try
yeah. And when you spend that money, what is the one thing that you got to do?
I gotta shoot you the receipt.
Yeah, you got to save that receipt and send it to the person who is collecting the receipts, because saving those receipts is critical. You also want to have the person who's raising the money be a part of your tracking team, because the people who are raising the money, it's basically the same thing as spending the money. You need the receipts for raising the money. You need to know who the money came from, all of that. Anybody who has access to the bank account should definitely be on your tracking team. And then, of course, you got to think about who has time to organize the information.
Jesus.
So, who is on the tracking team for your organization? Thinking about this. For PJP, it's me and Aramis and anybody else who's spending money. So if one of our leaders, buys some food for an event and gets reimbursed, then they have become a part of our tracking team, because I need that receipt from them. I need the reimbursement form from them. The people who are helping us raise money, our fiscal sponsor is on our tracking team.
Yeah. The back office.
The back office. Yep. So
the real work.
So each person on the tracking team is going to have a seat at the table, right? They're going to have a role and responsibility. Very important to agree on authority to make decisions. Within PJP, we actually have written policies about how, oh man, because this is the part where you're actually,
I can hear you.
I'm teasing you. I'm teasing Aramis because this is the part where Aramis actually has the authority as the executive director about how we spend our money. So any expense that we have over a certain threshold, and this is what it says in our policy, needs to be approved by the executive director. And so that just happens to be how our policies are written. Your internal policies about, decisions about who can spend money and how much and all that may be different, but it's important to agree on that authority about who can make those decisions and follow through. And then, yes, like I said, ideally these will be in writing, which helps with clarity and transition or turn, if you have turnover, that sort of thing, if you have new people coming in, etc. Welcome, Maya, to our webinar. We are recording, so I won't ask you to introduce yourself right now, and feel free to stay off camera if you'd like. But we'll pause the recording later and we can have a conversation too. Okay, so next is, after you develop your team, then you want to develop a tracking process that team will implement. So how will communication happen when expenses are incurred or revenue is received? So like I said earlier, when Aramis uses the company credit card or whatever to purchase food for the event, then he's got to save that receipt and send it to the person who's tracking it. So that kind of communication is what we're talking about. But it's important to know what amount of detail is needed with that communication. It's really important to communicate the date that the transaction occurred, how much money was in that transaction, who was paid, and all of that, of course, is going to be on a receipt. The part that's not going to be on the receipt is the purpose, or in bookkeeping speak, that's either the account or the class. We'll talk a bit about that later. That gets to the idea of categorizing your expenses, and those categories are part of how then you're able to tell your story as an organization. So I mentioned that, financial tracking happens over specific periods of time. So it's important to think about what are your fiscal year dates. Here at PJP, our fiscal year goes on a January to December year. So we follow the calendar year, but a lot of other organizations use the July to June fiscal year. The federal government strangely uses a October 1st to September 30th fiscal year. Just completely different from like everybody else. Mm-hmm. So then a part of making your planning process is deciding how you will track the information. Are you going to use a spreadsheet? That's fine, especially if you only are going to have like 5 expenses per month or something like that. But once you start growing beyond, a few $1,000s a year, you might want to use some accounting or bookkeeping software. And eventually, hope, you'll get to the point where you're like, this is too much for me to do. And it's okay to employ a bookkeeper. And that person then would be a part of your bookkeeping or tracking team. Of course, that doesn't mean that you can wash your hands of all the tracking tasks. It's just that the bookkeeper is going to be the one chasing you for the receipts. And the bookkeeper is going to have lots of questions about what was the purpose of this expense. So there are many elements, many ways in which a bookkeeper can save you time. And you'll still need to work with them, especially in the beginning, until they better understand your organization. Okay, so next is creating the tracking calendar. So starting with your fiscal year, as I mentioned, PJP's fiscal year is January to December. So, we start from that standpoint. Then you got to plan out when your major expenses are likely to happen, if you know them. For instance, PJP every year, we print our Take Black the Vote voter guide. And we printed, how many did we print this last year? I want to say we printed like 600, something like that. And these are, a booklet of like multi-pages and all of that. So it's a pretty big expense. And so we know that in the summer, we're going to have that big expense. Additionally, if there's, some other big event that you're having during a certain period of time, you can plan out when that's happening. Or if you have staff or, contractors that are paid on a monthly basis, then you don't have a major expense once or a couple times in the year. You have it like every month. So then you can plan out when that's going to happen. It's a good idea to do quarterly check-ins on spending and revenue. Here at PJP, I work with Aramis, our executive director, and our board. I communicate with them quarterly about what our spending and revenue is looking like, and communicate about any big outliers, like, hey, looks like we're spending a lot more on this line item than was expected, something like that, or a lot less on this line item than was expected, and a brief explanation why. That kind of communication is really important, both for transparency and for helping those decision-making bodies to be able to make better decisions in the future. Like, okay, this last year we saw that our utility bills were a lot higher than we expected. We need to raise probably that line item in our budget next year, something like that. And then integrate reporting deadlines into your calendar. So this is just a sample of like a report. Some grant report is going to be due on XYZ date. So that kind of financial reporting is going to be due at that time. And so then you could have a goal of having all of your income and expenses entered by like a month before that goal, or a month before that report is due, that sort of thing. And then stay on top of it and check it. I would recommend, especially for an organization that has like a moderate number of transactions every month. If you only have 5 transactions a month, then you could, monthly data entry is still probably a good idea, just so you don't forget what things are for. But it's likely that you're going to have more than 5 transactions a month. So it's usually a good idea to do some sort of data entry check-in at least on a weekly basis. And then monthly or quarterly if you have fewer transactions, but at PJP we do it monthly, reconciliation. So you reconcile your records with the bank statements and donation reports to make sure that they match. Because if you forgot to record XYZ transaction, but it's on your bank statement, then that's a way to double check things and make sure that you have everything correct. This third bullet is trash in equals trash out. So just saying that if you are entering information willy-nilly, no standardized way of entering it, then the reporting that you get out from that is gonna be kind of trash. Because if you don't have a standardized way of entering it into either your spreadsheet or your accounting software, then it's like you're trying to add up apples and oranges together, and so you're not going to get the correct amounts at the end. Who's on first? Aramis, do you remember that old joke?
No, I don't.
No.
Who is on first? Emily?
I think, who is on first?
Yes.
Yes, who is definitely on first. I don't remember the whole thing. It was like an Abbott and Costello stick, and who's on first and what is on second and why is on third or something like that. Anyway. I
trust that it's funny.
That's the perfect response. Thank you. So the crux of that joke is that these people are communicating with each other, but crossing paths. They are not understanding each other at all. So in order to avoid that kind of thing happening, it's important to communicate regularly between the members of your team. So if you do have a bookkeeper, it's really important to communicate regularly, to share information and assumptions. Assumptions are really important, right? Because if I'm assuming that my bookkeeper knows that all of these transactions from this event are training transactions, like that, those belong under training, but it's for things like water and granola bars and gas for the car, then my bookkeeper is going to look at that and be like, oh, this is food and that's travel. And whereas what I want to communicate is how much money we spent on trainings. And if all of that money was for the training, then shouldn't it go under trainings, right? So those are the kinds of assumptions. And that's also a really specific way of, or that's a specific example of how you can communicate about your mission through the categorization. And then the second piece here is document. So not only communicating your own assumptions to somebody else, but also communicating them to your future self. So any assumptions that you have or formulas, especially, for those of us who use spreadsheets and use formulas within the spreadsheets, like calculations. And it doesn't even have to be the fancy calculations, right? It could be in one line item, especially like a budget or something. I'm assuming, oh, this bill is going to be $15 a month for 12 months. Write that down so that whatever 12 times 15 is. I can't do that math in my head right now. That, you'll just show that total there. But if you haven't documented how you got to that total, then you might not remember next year when it's time to do the budget again. Yeah. And then the last big step here is to add it all up and communicate about it. So it's important for probably one person to compile all of the information and review it for consistency and then distribute it to everybody else involved. That allows there to not be, as it were, too many cooks in the kitchen, but then also it allows other people to make sure that the information is correct. But then also you can communicate that information more broadly to funders, donors, etc. Even in your annual report, a lot of organizations communicate financial information in their annual report. When you're communicating, you don't always need to include how much money you budgeted for something and then how much you actually spent on it, or how much money you budgeted you were going to raise and how much you actually raised. But that kind of information can be really helpful for determining your budget for the next year. And then it also can be a really useful way to be able to forecast your cash flow. Because if we make a budget for the year and it totals, say, $10,000 in total at the bottom, and we are halfway through the year and we've already spent $8,500, then we can look at that and think, okay, we're only halfway through the year and we've spent more than half of our money. Can we forecast our cash flow in such a way that helps us paint a picture for, are we going to run out of money by the end of the year? Or is it just that all of our activities happen in the first half of the year, not the second? How to tell your story with numbers. Oh. Do you feel, Aramis, do you feel like we tell a story with numbers when we report?
Yes.
What kind of story do you feel like we tell?
Well, a lot of ways, depending on what we're reporting.
Mm-hmm.
You can see by numbers don't lie, just like history. Mm-hmm. Numbers and history don't lie. And so with numbers, you can see the level of success of your efforts through a time period, whether you need to fix something, whether you need to do better, or you went too far and you're like, well, we did that. Well, that was crazy, and you can also estimate what can happen the next time. Mm-hmm. Even like in current history, we can look at the past report, whether it's the funding report or the social media report or anything with numbers on it, and project what is possible if we either match what we did to get there or push further to make a giant leap. Mm-hmm. Something. In other words, you can like test where you're at.
Yeah, absolutely.
Oh, that was right. That's cool.
Yeah, that was great. So here's just like, I feel like I've gone to a bunch of like accounting and so forth, webinars and conversations, just even to like wrap my head around what I'm supposed to be doing and all of that. And at the beginning, when I first came into it, they were using language that maybe I had heard some of these words before, but I didn't necessarily know what they all meant. Net assets, amortization, reserves, deficit. I think we all probably know what a deficit is. But there's also a difference between deficit and debt. There's other words that I can't think of right now, but wanting to like demystify some of those words as well. So income is, of course, the money that you take in, and expenses is the money that you spend. And when you take your income and subtract the expenses over the same period of time, like last year we had an income of $40,000 and our expenses were $30,000. So $40,000 minus $30,000 equals the change in your net assets. So your assets are like your savings account, as it were, if we're talking about cash. Obviously, if you own a building or something like that, that can be an asset. But generally, when we're talking about money, your net assets are like your savings. So if we had an income of $40,000 and we spent $30,000, we have $10,000 more in savings than we did the previous year. When your income minus your expenses is more than zero, we have a surplus. So that's this situation I was just talking about of building reserves. Reserves is just another word for savings. When your income is minus your expenses is less than $0, we have a deficit. And at that point, it doesn't necessarily mean that you are in debt. It might mean that you're drawing from your savings, drawing from your reserves. Hopefully you have some reserves. If you don't have reserves, then you are going to be in a situation of owing people money. And that's probably not a good place to be unless it's planned well in advance. So I was talking about categorization. So how we categorize our expenses happens in something called a chart of accounts. So within your chart of accounts, you're going to have your revenue, which is another word for income, and your expenses, which is another word for expenses. So your revenue or your income there's contributed revenue, which is donations, basically donations, grants, etc. And then earned revenue. So that is income from providing a service, or, like if your organization sells t-shirts or something like that. Or a service, like your organization does trainings and gets paid for those trainings. And PJP doesn't engage with government contracts, but some government contracts, that revenue is considered earned revenue. Then on the expenses side, expenses are generally in at least two categories: personnel expenses, which means people, salaries, etc. And with nonprofit budgets, generally salaries or personnel are the most expensive line item in any organization's budget, usually. And so generally then they are listed at the top of the expenses. Non-personnel expenses, then you can group them based on, into other meaningful categories based on your activities and based on your mission and based on how you want to communicate about that mission. So to the right here is a sample profit and loss statement. Profit and loss is another word for revenue and expenses. But within Like if you're using QuickBooks, it's going to be called a statement of activity or profit and loss. Those two things are interchangeable. So up here is the income. So this organization has income of $15,000 basically in contributions, and they had one grant from ABC Foundation for $1,000. So their total income is just over $16,000. And then here, all of this is their expenses. Now, there are a few things here. I wonder, can I zoom in? I don't know if I can zoom in here, but I would like, nope, that's not working. Okay, well, what I'll point out here is right here, marketing and promotion is $9,000. And program expense is $20,000. So already, what do we know about this organization? They have spent more money than they brought in. Oops. But maybe that was planned, right? Like it's possible that the previous year they got a big grant that now they're spending down, something like that. If that does happen, there are other ways to be able to communicate about that on your profit and loss statement or on your balance sheet, which is a different thing that I'll talk about in a minute. So yes, we can see that they are have spent more than they've brought in, but also like here, office supplies, $28. Office expenses, $331. What's the difference between these two? Maybe we should combine those things, right? So like, let's think about how our categories are actually useful for telling our story. So with this, you know, program expense, what does program expense even mean? Maybe that needs to be pulled apart so that we can actually say, oh, well, the XYZ program, you know, spent that much money, and the KMN program, that's not how it goes, but it spent, you know, this much money. Okay, well, now we're communicating about the different programs within our organization. That's just one way to communicate about it, but as an example. Okay.
You're saying like break it up, right?
Either break it up or roll it up. So like here, office expenses, office supplies, postage and delivery, all of these things are relatively small amounts of money and could be combined together. Yeah, they're all administrative costs. Okay, so the type of financial reports. So we just looked at a profit and loss. So that shows what the organization has earned in revenue versus what the organization has spent in expenses over a specific period of time. It's always a specific period of time. Then you could also have a program financial report, which is a snapshot of information related to a specific program, usually in profit and loss format, but it's not going to be for your whole organization. It's just going to be for a specific program. And that is more important if you're providing information to a funder where the funding is specifically earmarked for a single program. And then the last one here is a balance statement. So a balance statement shows all of your account balances on a specific date. So usually that is like if you're applying for a grant, they're going to ask for a balance statement at the end of your last fiscal year. So for PJP, that would be December 31st, 2025. And so our balance statement will show how much money was in each of our accounts, and what our current liabilities are. So if we have money that we know we're going to owe, that kind of thing. That might be money that if we did have a loan, it would be money that is in a loan. If we have a credit card, that's actually a loan. So the money that we owe that month on the credit card, if it hasn't been paid off yet, then that money would be under liabilities. But so that's where you have assets and liabilities on your balance statement. The assets, again, being the money that you have, usually money, and the liabilities meaning the money that you owe. So let's see, budget dashboard. Oh, this is where I was talking about looking at what your target was and then breaking it out by quarter so that you can maybe imagine what your cash flow is going to be. So this might be the kind of reporting that you could provide to like a board member, your board or your board finance committee, something like that. So this shows the first quarter, and it compares the total fiscal year and quarter one goals with actuals. Actuals means what actually happened. These are the amounts that, came in revenue and were in expenses. So our plan for the whole fiscal year was that we were going to have $250,000 in revenue, $230,000 in expenses, and we were planning to add $20,000 to our reserves. This is just made up numbers, by the way. When you break that out by each quarter, we expected that 23,000 of this 250,000 was going to come in during the first quarter. Most, let's say for this organization, most of their grants come in later in the year. So we were expecting to bring in 23,000, but spend 39,000. So we were expecting to actually have a deficit. But apparently ABC Fund increased their grant. On the previous slide, their grant was $1,000. Now it's $45,000. Woo. So they increased their grant. And we also have an increase in expenses because, and this is those little notes that I was talking about earlier to explain the discrepancies. So here, this note tells us that the ABC Fund grant increased. And then this note tells us that the healthcare benefits increased, that the cost of healthcare benefits increased. So our expenses are larger than what was planned, but our revenue, fortunately, was larger than what was planned as well. So instead of being $16,000 in deficit for that quarter, we're actually $2,000 in surplus. Thank goodness, right? But this can go up and down through the year. So you want to check in on it, usually quarterly, to see how you're doing. Depending on how quickly things are moving, sometimes you need to do it monthly, but at least quarterly.
Mm-hmm.
And then forecasting cash flow. So I talked about this a bit, but so when you are preparing cash flow projections, you want to include the cash that you have for the beginning period, add any sources of funds that you know are coming in. Of course, subtract out any expenses that you know you're going to have. And then at the end of the period, that's the cash that you're going to have on hand. So that's how you can see, what it's going to be through each period of time. You definitely want to monitor this. That's what we kind of went through with this dashboard. This is like a monitoring of those funds. So you want to, yeah, like I said, either monthly or quarterly, depending on how quickly things are changing. And then you want to review it's good to review a 12-month cash flow, a rolling 12-month cash flow projection. And review it with your whole team, right? So it could be staff, definitely to a certain extent board members, depending on, how in the weeds they are with the finances. It might be on a quarterly basis, like actively reviewing it with them, or it could be sending out, an update with written information. But I would definitely recommend going through it with somebody live in a meeting on at least a quarterly basis. Just so that, because looking at it on a screen is one thing, but explaining it to somebody else can oftentimes bring clarity that you hadn't thought of before. So this 12-month rolling cash flow projection then can also tell you what can help you anticipate problems ahead. So especially in this really volatile funding landscape that we're in right now, where the stock market is doing crazy things, which means foundations are doing crazy things. Sometimes that means individual donors are doing crazy things, less crazy than foundations, though. Always less crazy than foundations. And, prices for things are changing rapidly. In that kind of environment, you definitely want to be able to project out any cash flow issues you're going to have well in advance. So here's an example of cash flow for this organization called GRR.
Yeah.
It's actually a real organization.
GRR.
So as you can see, they run in deficit for most of the year. So February, they have an influx of cash, and June and a little bit in October. So those months, they bring in more money than they spend, but the rest of the months, they definitely spend more money than they bring in. But in December, that's when they bring in all their money, and that makes up for the rest of the year. So with an organization like this, and a lot of organizations are like this, especially if they primarily rely on individual donations, the vast majority of their money is going to come in December, because that's when people give. It's the end of the year. They're giving because it's so that they can put it on their taxes, or because it's the season for giving, or whatever it is. And so that's when, you get all this money, but then you have to make it last all the way until the next December. So that's, yeah, it's like spreading that peanut butter out over the bread of the whole year.
Word. It's about spreading the peanut butter, folks. Spread the peanut butter slowly, edge to edge, and make sure it doesn't go off the bread.
Exactly. Yeah. Well, I mean, if some of the peanut butter goes off the bread, then you can save it in your reserve funds. But you don't want to spread the peanut butter too thin, so that then you're not actually investing in your mission, right? If you're not spending money and investing in your mission, you're not going to be able to keep your organization afloat. And because people are going to be like, what are you doing? You're not doing your mission. I go too crazy with my metaphors sometimes. That's Aramis's face right now.
Yo, yeah. I was giving to keep going with it, but we don't have time.
I know. Okay.
I had so much more to contribute.
So there are a couple of important risk factors when considering budgeting. Are you communicating about your finances in a confusing way or a clear way? Because when you send in that grant, you are not there standing next to that person to answer questions about your budget or about your financial report. You have to communicate those numbers with, with language, right? With the categories in a way that somebody on the other side of the country or in, 3 months when they finally read the grant or whatever, you have to communicate in a way that they are going to understand. And they don't know anything about your organization. So communicating in a clear way is really important. And then in investigating those discrepancies between your budget and your actual numbers, also really, really important, because if you were planning for your, the food at your trainings to be $3,000, but you ended up spending $5,000, and then next year you budget $3,000 again, you're not gonna, that's not good planning. Okay. And then one last thing, I actually already touched on this, because it is okay to spend money. Spend money where it matters. Spend on the things that make your organization better. Invest in people and the community. Invest in staff members. Honestly, doesn't have to be staff if your organization is all volunteers, but the people who show up, invest in those volunteers. Like, even if it's just giving folks, little thank yous for volunteering or something like that. Like, building that community, that's oftentimes the key of, if you have a small amount of money, maximizing that small amount of money. And then have a vision. Think long term when you are planning on how you're utilizing your money, and plan for those future successes. So, like, if you get a little windfall of, let's say you've been plugging along with $5,000 a year, and all of a sudden you get a grant that's $15,000. Don't spend it all at once, right? Plan how you're going to spend it so that you know that you are not only delivering on whatever it was that you promised to the funder or to the community that you were going to do, but also invest in your organization itself so that you can ensure that your organization is there for the long haul. Because we know that foundations are fickle, and they will change their minds, and they might not fund your grant next year. So if you want to continue that program past that grant end date, then you better spread that peanut butter. Okay, thank you. That's it.
Any questions? Buddy, Maya still here?
Yeah, I'm gonna stop the recording. But